Okay, good morning, everybody. Welcome to this live webinar with me, James Phillips, Deputy Editor of Professional Pensions, and Lisa McCrory, Chief Finance Officer and Chief Actuary at the Pension Protection Fund. Thank you very much for joining us today, and apologies for the slightly late start, but it's a very exciting webinar I've got lined up to you today because we're going to be discussing the 2021 Purple Book, also known as the Pensions Universe Risk Profile. And this book looks, as I'm sure you're familiar with, at how schemes and the PPF fared in the year to the 31st of March 2021, and understands the latest trends in issues such as asset allocation, demographics, levy, and risk reduction. This webinar will be on demand later too, so at some point the video will be made available if you'd like to look at it again or share with your colleagues, including the slides. But the whole Purple Book is available on the PPF website with all its glorious data for you to look through and prepare your questions for us throughout this presentation. If you look at the bottom of your screen, there should be a Q&A button. If you click on that, that's where you'll be submitting your questions today. So do get those through at any point during the presentation, and we'll pick them up in the Q&A session at the end, as many as possible. But that's been pretty much from me. So first up, Lisa is going to take us through the key data from this year's edition. So over to you, Lisa.
Thanks very much, James, and good morning, everyone. Thank you for joining us as we launch our 2021 Purple Book. As James said, the book provides a lot of useful and unique insights into the characteristics of the UK private sector defined benefit pension schemes. And these are the schemes that we at the PPF are here to protect. I think the book's very unique for two reasons. Firstly, it covers nearly all the DB pension schemes. We've got data on 99% of schemes, and it's quite comprehensive. It gives you an insight into the scheme demographics, scheme funding, as well as the investment strategy, and a lot of information on our own funding too. It doesn't only show today's characteristics, it tracks them all the way back to 2006 when we first launched our Purple Book. And I guess that's where the interesting stuff really is, where we can see the trends that have emerged over time. The Purple Book really is an internal document. We produce it as part of our risk management framework here at the PPF. And by understanding things that have happened in the past, it can help us inform how the risk is changing in the future. And I think this year has been a particularly interesting year for DB finances. And so I will be talking a bit about how funding in the universe has changed and also our own fund position. But first of all, I wanted to start off by pulling out some of the main demographics of the universe of DB schemes. So if we start with the number of schemes, and I think nobody will be surprised to know that the number of DB schemes has been in decline. Back in 2006, we had 7,800 schemes, whereas at 31 March 2021, that had reduced to just over 5,200. So we've lost around about 1,600 schemes, 100 of those left the universe in the year we're considering today. We don't track exactly what happened to each scheme, but what I do know is that we've now had over 1,000 schemes transfer into the PPF. And so we can be pretty confident in saying that up until now, the main reason DB schemes leave the eligible universe is through an insolvency event and transfer to the PPF. A big consideration for me in my role as Chief Actuary is around what's going to happen to these schemes in the future, how many are going to leave the universe, and of those, how many are going to come to us here at the PPF. And I'll talk about that a bit more later on in my presentation. And if we look at the number of members that we've had, you can see that that followed a similar pattern, and actually the rate of decline in membership has been very similar to that of schemes. We do expect, however, that we may see a more rapid decline in membership over time, really reflecting the fact that the DB universe is now an aging population. And then if we start to look a bit more detail of the schemes in the universe, and in particular, what schemes still provide benefits to members, and we'll start with the purple bar here, which are open schemes. And we can see that very early on in the PPF existence, DB schemes went through a radical closure to new entrants, but in recent years that decline has stopped, and it's now pretty constant, the number of schemes that provide benefits to new members, currently 11%. The more recent trend that we've seen is those schemes that had previously closed to new members are now closing to benefit accrual. So that's the green lines moving into the blue. And up until this year, we've always had more schemes in the universe providing some form of accrual than those that didn't. However, this year we're now 50-50, and we can be reasonably confident by the time we get to this time next year that we'll have more schemes in the universe that don't provide any further benefits than do. Although I said there was 11% of schemes still open to new members, we know that actually there's only 10% of the DB universe of members actually receiving or accruing benefits currently, which equates to just under 1 million members. Next, I wanted to talk about the size of schemes. And as you can see from the chart, the eligible schemes that we protect are made up largely of small schemes less than 1,000 members. And then we have a few very large schemes too. And the statistics that we normally quote here is that 7% of schemes have a membership of over 5,000 members, but these 7% of schemes cover nearly 75% of the liabilities, asset and membership in the DB universe. So it's probably not surprising to hear that most of our claims profile comes from smaller schemes, although typically we do have one or two of the larger schemes too. So the risk we face in the future will be in some way correlated quite closely to some of these bigger schemes. I think one of the most noticeable trends in the Purple Book over time has been the switch out of equities and into bonds. So we can see the green line there shows you the bond proportion, and that's now at over 70%. This chart's looking at total assets, so looking at the assets across all schemes. So in some ways it will be influenced quite heavily by those larger schemes that I just talked about. And when you look into the data sitting behind this chart, what we actually see is there's quite a lot of variability in investment strategies across schemes. We know that open schemes and smaller schemes tend to hold more riskier assets. And we also observed that around 20% of schemes still hold more than 50% of their assets in equities, and around half of the schemes in the universe hold less than 50% of their assets in bonds, which typically provide a better match for your liabilities. So we can conclude that there's still quite a lot of investment risk in the system. Finally, before I move on to scheme funding, I wanted to talk briefly about risk transfers. And this slide looks at buyout and buy-in activity, as well as the number of longevity swaps that have been transacted in the past. And we can see that there has been quite a noticeable increase in buy-ins and buyouts in 2019, 2020. 2021 so far has got off to a bit of a slower start. But I think although the numbers are increasing, the amount of liabilities transferring out of the universe is still very small in the context of the total liabilities that we protect. And therefore we expect it will still be a number of years before the trend to buy and buy out has a material impact on our landscape. So moving on to funding, and when I'm talking about funding in this context, I'm referring to our Section 179 funding basis. And what that is essentially an estimate of securing PPF levels of compensation with an insurer. If a scheme is underfunded and the employer is insolvent, the scheme will most likely transfer to the PPF, and similarly, if it's overfunded, our expectation is that it will transfer to an insurer and secure benefits above PPF levels. So in that measure, the Purple Book shows that 51% of schemes were in surplus, 49 in deficit. And that's really good news. We haven't actually had very many times in the past when there were more schemes in surplus than what were in deficit. And the even better news is that every month since, we've had more schemes in surplus than in deficit. So that was the good news. The bad news is there's still quite a significant number of schemes in deficit, 49%. And we know that there's quite a range of funding levels in those schemes making up the deficit. And we can see that if you add up the deficit that exists in these schemes, that comes to an aggregate position of 129 billion. Now, clearly that is a very big number, and it gives you a measure of the risk we here at the PPF are underwriting as at 31 March 2021. You may be familiar with our funding strategy. Currently, we aim to build reserves so that we can remain financially self-sufficient after our funding horizon, and those reserves are there to protect us against adverse future experience. As at 31 March 21, our reserves were £9 billion, and those reserves are there to help protect against future claims, but they're also there to help protect against adverse experience for the members that we have today. And I guess one of the big risks that we face is longevity risk. So as you probably gathered from the last slide, the year to 31 March 2021 was very positive in regards to scheme funding. The universe seen its funding level in aggregate improve from a position of 95% as at 31 March 2020 to 103% this year. And what I mean by aggregate position is that if we add up all the assets in the DB universe and divide them by the total liabilities, the funding ratio would be 103%. And this is a very significant improvement over a one-year period, and it has been driven by favourable market conditions. And what we can see when we look at the data is that although a lot of the schemes have very different investment strategies, by and large, most schemes have seen their funding position improve. Nearly 90% of schemes' funding ratio has improved on the Section 179 basis. And I would also be expecting to see that schemes will have probably have had improvements in their ongoing funding basis as well, and hopefully for many that means that they will be a little ahead in terms of their journey plans towards their long-term objectives. And whilst this is certainly great news for pension schemes, I think it is important to remember that investment performance can be positive or negative. And so it's really important that trustees are monitoring their position and the risks they face. And I guess what I'll be really interested in seeing next year is whether any trustees have taken the opportunity to lock in some of these gains, and whether we'll see further de-risking in the universe. So if we look at how funding positions have changed over time, the purple line is funding for schemes in deficit, and the green line looks at schemes that were in surplus. And when you look at the graph, the first thing you see is the volatility. Funding has been bouncing about a lot. In recent years, there had been a trend into funding improving, and that will reflect the fact that a lot of the investment strategies have been de-risked. And we can see that little volatility that we've had over the last 18 months or so on the back of the market movements. And the good news is up until now, purple has been trending up again. It's not just the DB benefit schemes that have benefited from this favourable market conditions. Our own reserves have grown over the year to 31 March 21 to £9 billion. They were 5.1 the year before. And practically all of that improvement was a result of strong investment returns. Our own investment strategy is broadly made up of two parts. First, we hedge all our interest and inflation exposure, and then we hold some assets and growth assets in the hope of generating investment returns to help build our reserves. And those growth assets generated a return of £3.7 billion over the year. And this was a fantastic result for the team. And it was about 5 times above our targeted levels of return for that period. And so it also means that we're ahead of our own funding target. You can see there our probability of success, which measures the likelihood of us meeting our funding objective to be self-sufficient by our funding horizon, which we currently define as 110% funded in 2030. So our probability of success, there was 2 main factors leading to this improvement. First of all, our own funding has improved. Our reserves are there to protect us against adverse future experience. As they've got larger, it makes us more resilient to future claims, future longevity risks. So all else equal, we have a better chance of meeting our objective. Similarly, the funding in the universe has improved, and what this means is that our projections of future claims on the PPF are now lower, all else being equal. Just as I encourage schemes to review their strategy, we are already in the process of a strategic review of our funding, and our board are currently considering what all this means for us to going forward. I said at the very start of the presentation that we use the analysis in purple to help inform our assumptions of the future universe. And how that will change over time. And we use them assumptions in our long-term risk model. Our long-term risk model is a stochastic model, and it outputs 1 million scenarios of what the future might hold. And this chart's an output from that model. And it is the view of cumulative claims on the PPF up to 2030, which is our current funding horizon. And I think there's a couple of features to notice in this. First, the solid line shows you our actual claim experience, which is now at nearly £10 billion since PPF commenced. And then the fan starts to open out and show you some potential outcomes for future claims on the fund. And we can see there's a wide range of outcomes. And that's really just reflecting the wide range of size, investment strategies and funding levels across our universe. I also think it's helpful when understanding claim risks to have a look back at what's happened in the past. And this chart shows you the claims we have actually received since 2006. And I think the most noticeable feature here is that claims experience has been lumpy. We've had a few years when we've had claims in the fund close to or over £1 billion. And I think what's also interesting is when you look at this chart alongside the number of claims that the PPF has received. And apologies, I haven't shown it in the chart, but what you would see is that there were a significantly higher number of claims in the years following the financial crisis. But the years where the PPF actually experienced its worst claims, 2019, also corresponded with a period in time when the number of claims on the PPF was very low. And what that was telling us was that the experience in these years was dominated by a small number of large claims that entered a PPF assessment period. I quite often get asked, how does the claims experience on the PPF compare with insolvency experience in the wider economy? And this chart gives you the answer to that quite closely, actually. We can see in the green line the insolvency rates of England and Wales that has reduced significantly during the pandemic, most likely as a result of the support packages in place for corporates during that time. Clearly, and a very important question for us here at the PPF is what's going to happen with insolvency rates over the coming year. 18 months. If I was to extend this chart to a current date, we would see that the England and Wales insolvency rates have started to increase again. They're now at a level similar to where they were pre-pandemic. However, so far, we haven't seen that feed through into claims on the PPF. That said, our central modelling assumption is that we will start to see more claims in the next 12 months again. So before I open it up for questions, I think this year's Purple Book does give us some reasons for optimism. Our own position is strong. We're resilient. We're here to protect members, whatever comes next. Scheme funding in the universe has improved, and claims experience so far has been light despite the challenges of the pandemic. We do, however, see that there is still a lot of risk in the universe. Lots of schemes still carry quite a lot of investment risk. There is still quite a lot of underfunding in some schemes. And there's lots of challenges and uncertainties facing corporates in the months ahead. So our central view is that there will be risk in the universe for years to come. So I will finish there, James, and hand it over for questions.
Thank you very much, Lisa. And we've got, excuse me, we've got a number of questions already coming in, and there is plenty of time for you to get yours in if you haven't yet submitted yours in. So do just look for that Q&A button at the bottom of your screen. If you can't see, you might just have to wiggle the mouse around. But yeah, plenty of time. But perhaps I can take the chair's prerogative, and Lisa, perhaps put the first question to you, which is, I think, one of the most striking statistics to me in the data, and you brought it up earlier, was the fact that we're now at this kind of 50-50 position in terms of schemes which are continuing to accrue benefits and schemes which are not, which ultimately suggests that next year it will swing the other way, and ultimately we might even have an on aggregate kind of cash flow negative DB universe. How do you anticipate that changing the way that risk is presented in the DB universe, and the kind of type of claims that you might be getting in the future, and how they impact with your kind of investment strategy and risk?
We always expected, this trend to continue, and it has been on our radar for the last couple of years that we would meet this point in the next 2 to 3 years. So it's already been factored into our strategy to some extent. Our central modelling assumptions are that claims will reduce over time as scheme funding improves, and that's good news for members, and as a result of that, our levy income will fall too. It is risk-based, of course, and the amount of new money that we take in from schemes transferring should also decline too. So we've already factored that into our strategy and our planning for the future.
Thank you. And another thing that stood out was the fact that the number of open, or the proportion of open schemes, has remained relatively static for a few years. Do you kind of expect that trend to continue too?
That's an interesting question, and I think, looking back in time, it's not probably a trend I would have expected. I know certainly when I started out in pensions, the narrative has always been that DB pension schemes are a declining industry, but we certainly don't see that in the open schemes. There has been a chunk of schemes remained open for a while, and it's just one we're going to have to watch and keep an eye on. Excellent.
Right, so let's turn to some of the audience questions. I think perhaps naturally there is a key question on levies, Lisa. Considering the improvements in funding levels and indeed in your reserves, there was obviously the question that Steve Webb, this is Steve Webb's comment. So he says employers might feel that PPF is awash with cash, partly because of good investment performance, so kudos to you, and you might now be overdoing prudence in their opinion. So given the pressure on British industry, should the PPF be considering a bold cut in the levy, especially given the dwindling contribution of levy to overall PPF funding? And then linked to that, if I may, David Robbins at Willis Towers Watson has mentioned that one of your tables in the Purple Book talks about how a 10% reduction in levies would reduce your modelled probability of success by less than 0.5 percentage points. So essentially asking, do you think that perhaps your ability to cut the levy and then come back from it if needs to might be limited by legislation stopping you from increasing levies year on year by more than 25% if things went terribly wrong?
That's a lot of questions.
I know, sorry, it's a lot to put to you, but it all links together.
It does. You can keep me right if I have missed any of the points off. Clearly, the board keeps a close eye on the risks that we face as the PPF and how things are developing in the universe of schemes. We've already consulted on our levy rules for this year, and we have seen a reduction in levy reflecting, the strong performance in scheme funding over the year. It has always been in our strategy as the rest of the PPF faces declines that the levy should fall to. But I would remind people that the changes that we've seen over the last year, whilst dramatic, it wasn't that long ago when things were looking quite different. And as I said in my presentation, I think it is really important that trustees continue to monitor their own funding positions and make sure they're making the right decisions given the recent past. Was there anything I missed, James?
I think there was just a question about whether essentially whether you needed more flexibility to be able to increase the levy by a certain, a higher number if the worst happened.
Well, at the moment, I think we're pretty comfortable with where we are, but the person who asked the question is right. There are constraints on our levy abilities. I would also point out that the reserves that we hold, they're there for claims. There's other risks we face too, and like any financial institution, it's important that we hold the right amount of capital to match those risks going forward.
Thank you. I mean, one of the another piece of data within your Purple Book that stood out to me was the fact that the number of schemes that are paying a lower levy or no levy at all has actually increased over the years. And I think part of that is perhaps due to some of the easements you put in place during COVID. Is that correct?
The schemes that pay no risk-based levy, that will reflect their funding position, that they're in a strong position, thereby the risk that they face to us is quite low. So that trend will really reflect improvements in scheme funding in the universe that we have seen. But you're right, there has been some easements that we've put in over the period of the pandemic to help our levy payers. And obviously we keep them under review and react as things unfold.
Thank you. So to talk more, go back to some other bits of the data. One thing that seemed to stand out as well was that some of the biggest improvements in funding or the highest levels of funding were seen in the very smallest schemes and the very biggest schemes. But the schemes in the middle perhaps didn't fare the same. They still saw an improvement, but certainly seem to be have more of a funding shortfall or not as good as an improvement. What kind of risk does that present to you? Because I know you did mention that the largest number of your schemes are in the very, very smallest bracket. So how much of a concern is that middle area for you?
Any schemes with underfunding is a concern for us. They're the schemes that potentially are at risk of coming into the PPF over the longer term. and our modelling does reflect the data. So, you know, the decisions we are making are driven by the information we get from the Purple Book in terms of funding across the years.
Thank you. So let's go back to some of the data you have on insolvencies in England and Wales, but also in the PPF universe. As you saw in your chart, there was a higher number, or there was an increase in the number of insolvencies in the PPF universe and a decrease in England and Wales, but you said that started to tick up. Charles Escott asked, do you feel the level of claims on the PPF in 2020 and 2021, I suppose linked to that insolvency rate, is realistic or artificial, perhaps held back by changes to the insolvency regulation during COVID? Ultimately, do you think the level would have been higher without COVID allowances and extra support being made available?
Well, certainly this time last year, I don't think I would have been projecting the results that we've seen in the Purple Book today. So yes, it was certainly a lot lighter than what we were expecting in the early days of the pandemic. You know, I don't have the data to say what the real reasons driving that were, but I guess my best guess would be that it is related to the support packages provided to corporates during the pandemic.
And what would you, I mean, perhaps asking to make some guesswork here, but why do you think that perhaps the PPF universe experienced a different rate of insolvency, completely the opposite direction to the wider England and Wales data?
Well, being a mathematician by trade, I would say that's just statistical noise, really. You know, the PPF population is quite small in relation to the corporates of England and Wales. So, you know, you would expect some normal variation between the two. So I suspect it's probably just that. I'm sure if we were to draw confident infidels on the chart, we would see that they were pretty close, but I'm guessing.
And thank you. And the you obviously, like you said, you talked about how the rate has gone up across England and Wales since the March data. What is the rate looking like for PPF universe data? In kind of, is there a correlation there or similarity?
So far this year has been another quieter year for claims. You know, we have, if we go back to that graph I showed of our experience, we have seen over the last 2 years a reduction in the number of claims, and that's a theme that has continued this year. As government support is withdrawn, obviously the economy is now facing new challenges, given the recent news and developments around the pandemic. So we're watching with interest in terms of what will happen over the next couple of months. But, you know, I think we are a long-term institution. We're here for the long term. We fund for the long term. So we shouldn't be overly bothered about individual years of experience. As we've seen in the past, we've seen some quite lumpy experience, and that's exactly what we would expect to see in the future. And our funding strategy and holding them reserves means that we do have the resilience to cope with a bad year when it comes.
Thank you. So let's turn to some of those key risks that were included in your document. Towards the end, you kind of talk about some of the main problems you could potentially face. Obviously, being extremely prudent perhaps, but one of the key risks that you highlight is the potential for extreme claims representing £12 billion over the immediate term. Now, I don't want to make predictions, I'm going to regret, but this does feel like a real worst case scenario. But at the same time, you have highlighted in there about, and again in your presentation you did so, you know, how changes on longevity assumptions, volatility in a market, supply chain issues impacting sponsor covenant, etc., all big risks that could send scheme funding either way.
Yeah, My own expectation is, we won't see volatility in the universe like we've seen in the early days of the PPF. There is investment risk there, but in the main, quite a lot of schemes have taken some steps to de-risk. But the fact that scheme funding's changed by nearly 10% in 1 year as a result of market movements does give you an indication of, the level of volatility that we could see, up or down. So it is important that people keep that under review. Corporates have had a tough time. They continue to, it's not just the pandemic that's itself, the operational impacts and challenges, but there's many issues facing the economy at the moment, including inflationary risks, etc. So risk is definitely heightened, I would say, and probably more so in the last month or so relative to when the Purple Book was put together.
Absolutely. And actually linked to, because you talked about inflation there, and we're on this discussion about risks. I'm not expecting you necessarily to have the data to hand right now, but Mark Button has asked if you have any information on how kind of interest rate and inflation derivatives held by schemes could cause a change in funding sensitivity. So I suppose the question is about what kind of modelling have you done on a different types of assets, and how, I mean, particularly because you talk about a 15.3 billion improvement in net funding from a 0.1% rise in yields. I assume you've done modelling all over the place to have a rough idea of how different changes, inflation and derivatives and etc. would impact. I suppose it's also a scheme by scheme assessment to make.
Yeah, schemes will be impacted in different ways. Clearly, inflation for us is hedged at the PPF, so we totally 100% hedge our interest and inflation exposure. The impact on schemes will be varied. Schemes will have different levels of inflation-linked benefits, and there is a chart in purple there that tells you about pension increases in schemes, and we know that quite a lot of schemes do provide above statutory level of increases, and in particular pre-97 increases that are linked to inflation. So there will be some schemes where inflation will be a big consideration. We know that schemes do in general hold a lot of bonds and inflation-linked protection. Inflation is quite an interesting one to model, because obviously the impact on their PPF benefits is a bit more muted relative to their scheme benefits, because we have less inflation-linked benefits. But yes, it is something that trustees should be thinking about.
And another risk that didn't feature in one of the key risks at the end, as far as I remember, but one of the ones that you have faced over the last couple of years was the court judgments relating to PPF compensation. Now, you're mostly through, or maybe completely through, feel free to correct me, actually implementing those decisions. Is that correct? And so how much has that impacted how you've kind of assessed the risk and the funding of your kind of in-house population?
You're correct in that we've allowed for the financial impacts of it in our balance sheet. So them reserves that I quoted of the 9 billion, they make full allowance for the Hampshire judgment that requires members to receive 50% of their scheme benefits. Now, the impact of that judgment is quite small because most members receive a whole lot more than 50%. However, operationally, it is quite a complex process to go through because we need to recreate scheme benefits in order to be able to compare them with PPF compensation. The other part of that was the removal of the compensation cap, and we're starting to work through that project now, and our ambition is to make these payments as quickly as possible, and we should see that done largely in the next calendar year.
Perfect. And then to take, let's flip the question around. Rather than talk about risk, let's talk about opportunities. Now, David Robin has one that I think that you've probably faced in your past, but in a very, very positive scenario that perhaps the PPF gets to a position where it's got more money than it needs to pay compensation, and perhaps is very likely to have more, very likely to have more than it will ever need. Have you had a discussion? Have you made any idea of what you would do with that extra money?
I always answer this question that we're very early in our journeys to be chatting about that we're going to have money left over at the end. I think when I think about the progression of the PPF, I normally think about the PPF as a growing institution. It will then stabilize and mature, and then we'll finally enter a runoff phase. Quite clearly, when you look at our assets and liabilities, you can see that the PPF has been growing. I think the claims risk still exists in the universe. We still expect that growth in PPF for a number of years. The discussions that I have with our board around funding are very much focused on the upside as well as the downside, but clearly, as our mission is to pay members their compensations when they're due, it's only right that we hold appropriate reserves to make sure that we can fulfill that promise.
Excellent. Okay, so let's we've got some more questions, but they kind of tie into some of the recent kind of regulatory developments and indeed the funding developments actually too. But obviously, one big question on one big development on the industry's mind is the addition of CLARA as an example to the regulator's list of assessed super funds. It's not the only super fund out there. Other super funds may be available. This is clearly the starting point for the emergence of a functioning super fund market, though. So can you remind me and indeed the people tuning in today kind of how super funds will interact with the PPF, what kind of risks they pose to you, and how, what kind of things you've put in place to prepare for that risk or operate with the super funds?
Okay, so we've always believed that well-run consolidators have the potential to improve security for some members of DB pension schemes, but that can't be, at the cost of putting the PPF and our levy payers at risk. So, we are supportive of consolidators so long as they're accompanied by appropriate regulation and reserving requirements. So we really welcome TPR setting out their expectations in advance of the legislation. We would expect that super funds establish themselves as being eligible for PPF protection, and therefore, like any other PPF eligible scheme, they will be charged a levy. We've been working on a methodology specifically for consolidators, and that will set out what our expectations are.
Excellent. And the reason I ask in particular is because they've often been cited as an example to as an option for potential PPF plus cases. These are schemes that are in PPF assessment, but quite clearly have scheme funding level which is above, the Section 179 liability calculation, and would otherwise look to, ensure those benefits with an insurer at above PPF compensation level. So I suppose there are two questions here, one of which is from Daniel Henry, which is, have you seen any trends in the number of schemes under PPF assessment that are undergoing buyouts with insurance, i.e. at PPF plus levels? And two, how are you working, or do you anticipate working with super funds to if PPF plus cases were an option for them?
Okay, first of all, most of the schemes that enter a PPF assessment are actually underfunded. In our history, it has always been a small proportion of cases that are marginal or overfunded. The ethos embedded in our processes here at the PPF is that we want to find the best outcome for members. So we work very closely with trustees in the past to make sure that where a scheme has a realistic chance of securing benefits in excess of PPF levels, that our processes support that. And we would expect the same principles would apply with consolidators going forward too. Obviously, any scheme looking to transfer to a consolidator will need TPR clearance too. So we'll be working closely with all parties as that becomes to fruition.
Excellent. So we've got just over 10 minutes left, everybody. So if you've got any more questions, do get them in now so that we can get round to them. But Lisa, again, in regulatory developments, we've seen some improved powers for the regulator to introduce this year, which ultimately are designed to help improve, we reduce the risk posed to you at the PPF. Elizabeth Loosemore asks, however, whether you think there's still an issue of perhaps so-called PPF dumping, or companies stopping trading, but somehow that the company insolvency not being triggered and PPF drift being suffered. Is that something you still see? And do you think the new TPR powers could help in those instances?
We work very closely with TPR in all aspects of scheme funding and schemes that are in distress. So I think that relationship works well, and we support TPR in terms of making sure that we get the best outcomes for members.
But sorry, Lisa, but what was your view on, whether company, there was almost a deliberate dropping of PPF schemes into the PPF? It's
not been my experience of what the claims in the PPF have been. We've got quite thorough negotiations with schemes in distress and a well-established process with TPR to make sure that it remains robust.
Thank you. And the other development is obviously the upcoming revision to the DB funding code. Obviously, details are yet to be finalised, but obviously, I imagine you've been in discussions in some way, or the PPF has been in discussions in some way with the TPR about developing that and the kind of twin track code that is on the radar. How do you expect this to impact the risk posed to you at the PPF?
At this stage, it's very difficult to say what the end output will be. Obviously, anything that improves funding and security for members is a good thing from our point of view. But ultimately, there's a lot of very well-run schemes in the DB universe and a lot of schemes that are taking appropriate action. So I guess for them, the funding code's unlikely to make that much difference to what they're doing. But we will wait and see the details, and hopefully it'll enable us to get a better handle on the risks that some of these schemes face, and then we can reflect that in our decision making going forward.
Excellent. So we've got a couple more questions. So let's take you back to levies, one of your favourite discussions, I'm sure. But David Hodgson has asked whether how significant to the PPF as a proportion of total levy collections is the discount introduced for smaller schemes, and if you think this might be something that remains in place for the longer term.
Okay, so this is the small scheme adjustment I think that David's referring to, that was introduced last year. We review our levy rules every year. Obviously, it only applies to very small schemes whose liabilities are quite small. And so whilst it will have, I'm sure, quite a big impact on the individual bills of them schemes, it's quite small in comparison to the total cost of the levy. I don't have the actual numbers to hand, but you would be chatting single figure percentages impacts, I'm sure.
Excellent. So another question from Steve Webb actually here, which is about your investment performance. And he says that part of your great investment performance is because you can, at the PPF, can have an asset mix that maybe many occupational pension schemes would not be allowed to have. He wants to know if you think that's fair. I'm going to rephrase it slightly to think whether you think you at the PPF would benefit from incoming schemes potentially having access to some of the asset classes that you've been able to before they come into assessment?
Our investment strategy has played a huge part in, building up the financial resilience of the PPF. I think when we look back at our track record, performance has been strong. Yes, market conditions have been favourable for a lot of the time, but one of the things that we're particularly proud of is the fact that our investment team continue to outperform their benchmark, and that's in good circumstances as well as challenging markets. Our strategy has always been that we would grow our fund, we would reach a point where we were big, and that would enable us to do novel and exciting things. And Barry and the team work very hard to make sure that the investment strategy returns for a low level of risk, so that we continue to protect the members that we have today.
I think just to build on this question is, though, one of the long-term trends that you've highlighted in your report is that, basically equities down, bonds up. In terms of average asset allocation, it's almost on aggregate 75% of assets are in bonds. Do you think maybe schemes need to be looking at more alternative classes?
Well, I guess, what we're seeing in that trend is that schemes are starting to hedge their interest and inflation risk. So clearly that is something that we've already incorporated into our own investment strategy. I think trustees should be thinking hard about their investments and making sure that they understand the risks that they pose on the upside and the downside, and taking appropriate advice.
Thank you very much, Lisa. I'm afraid we've got about 5 minutes left, so I'm going to put this one kind of final question to you, which is, of course, and we have discussed this a little bit in certain spaces, but all of this data is from March 2021. It's almost been 9 months since then. Well, I'm sure you're already in the process of gathering data in a way, or at least looking ahead to compiling the 2022 Purple Book. I'm not going to ask you to say what the 2022 Purple Book is going to say, but what kind of experience have you already seen in the last 9 months, and what kind of risk or how is that impacting your kind of decision making at the PPF?
Okay, well, a lot of the data in the Purple Book we only get once a year because it comes as part of the scheme return, so I can't really comment on that. But what I can comment on is the funding in the universe. We publish every month our 7800 index, which tracks these funding levels that I talked about today. And so what we have seen since March is that the trend of improving funding has continued. It hasn't been as dramatic as last year, but it was certainly improving. However, the start of December has brought with it some new volatility in the markets, and yet again we've seen volatility in the bond market, and as we know from the Purple Book, that is what funding will be driven by. So I guess it's probably going to be another interesting couple of months to see where funding ends at 31 March 2022.
Thank you. I think the next index is out next Tuesday, if I'm right. So we'll wait and see what the position was at the end of November, and then into the new year after. Well, for the kind of end of 2021 view.
Yes.
Brilliant. Lisa, we've got just a couple of minutes left now, so I wondered if there was anything else that you wanted to draw out from the report, or any message that you may have to our listeners today in terms of preparing for the coming year, or the kind of risk that hedging or combating any risks posed to the DB universe that you'd like trustees to go away with today.
I think the last 2 years have certainly been a very interesting time. We've seen some real lows, and again this year thankfully it has gone the other way, and it has been very positive. And I think whilst I'm really pleased about that, and nothing makes me happier than DB funding improving, I think it really is a reminder of just how volatile funding should be and how important it is for trustees and their advisors to keep on track, monitor their funding and reassess their journey plans in light of experience.
Thank you very much, Elisa, and thank you very much, everybody who has joined in from wherever you may be today. That is the end of this webinar, I'm afraid, but hopefully it's been a very useful session for you. If you want to find out more information, of course, the whole Purple Book in all its glory is on the PPF's website. I would encourage you to take a look at that and the other tools available around it. And of course, this, as I mentioned earlier, this session will be available on demand. So if you want to share with a colleague or revisit it, it should be available on the PPF website in a short period or so. But thank you very much for being a very engaging audience. We had plenty of questions from you today, and I think we had a really useful discussion. But that's it from us today. So thank you very much. Thank you very much, Elisa. And everybody, I hope you enjoy the rest of your day. Thank you.
Thanks, James. Bye-bye.
Bye-bye.